Welcome back to the deep dive. Our goal here is always to cut through the noise, especially when the markets get, well, wild, like today. And if you happen to look at Opendoor Technologies, that's ticker OPEN today, September 23rd, 2025, you definitely saw some wild action, a really sharp move down.
Absolutely. This stock has been just incredibly volatile. It went on this huge, almost unbelievable rally recently.
Right, but today the story flipped completely. Open is sliding hard, down about, 11.34%, trading around $7.43 this afternoon. So our mission today is pretty clear. Figure out why this stock is suddenly dropping after that massive run-up. We need to weigh the really conflicting views on whether it can actually survive in this housing market.
And trying to get a handle on the real risks and rewards here.
Hmm.
Is it just a super volatile play, or is there something fundamentally, broken?
It feels like a defining moment for this kind of market, doesn't it? Because this dive feels less about Opendoor's specific business today.
And more about just how fragile that speculative excitement can be. Yeah. The price action today really tells you about the money flow, which can turn on a dime.
Okay, so let's get into the immediate cause. Why the sudden, really dramatic drop? I mean, this stock was up like 1,400% in just 3 months.
It's kind of mind-boggling.
Totally. It went from 50 cents to over 10 bucks at one point. What exactly happened in the last day or so to trigger this slide?
Well, the sources are pointing pretty clearly to just pure investor sentiment rotation. It kind of proves how much of Opendoor's huge surge was built on, let's say, social media buzz and hype.
Rather than solid business improvements.
Exactly. Not some big fundamental shift. Basically, the attention moved elsewhere.
How so?
There's a hedge fund manager, Eric Jackson. He was seen by many as kind of the unofficial leader pushing the Opendoor story, making that comparison to Carvana's turnaround.
Right, I remember that comparison got a lot of traction.
It did. Well, he recently announced he's shifting his focus. He named another real estate tech company, Better Home and Finance ticker BTR, as his next 100-bagger pick.
Wow. And just that announcement was enough.
Apparently so.
Right.
It's like the spotlight just swung right over. That pivot immediately pulled attention, and probably capital, away from Open.
And Open started dropping.
Instantly. Giving up those recent gains, down over 11% today, while BTR, the new pick, jumped, 27.5% today.
That's incredible. It really shows how thin the ice was under Open's rally if the hype leader moves on.
The speculative floor just vanishes.
Yeah.
Okay, volatile doesn't even begin to cover it. If one person saying, I like this other stock now, can knock 11% off the price in a day, how much faith can you really put in the fundamentals here? Was that whole rally just smoke and mirrors?
Well, that's the core contradiction and what makes this so interesting, because this slide is happening right after something that, on paper, should have been really good news for Opendoor.
You mean the Fed's decision?
Exactly, the macro event, the Federal Reserve. Yeah, just last week, the FOMC cut the federal funds rate by a quarter point, right? Down to the 4% to 4.25% range.
First cut since December. And they hinted maybe 2 more cuts this year.
And for a company like Opendoor, that should be huge news.
It really should. I mean, for an iBuyer running on thin margins and needing tons of capital, lower rates are theoretically the dream scenario. It helps on 2 big fronts.
Okay, what are those?
First, cheaper borrowing costs. Makes it less expensive for them to buy all the houses they need for inventory. That's crucial for their model.
Right, they need that inventory flow. And second,
Lower rates should eventually mean lower mortgage rates for home buyers. That gives people more buying power, which, again, in theory, should finally boost the number of transactions happening, get the market moving again.
so the Fed gives them a potential lifeline, signaling maybe borrowing gets easier and the housing market might thaw. But the stock tanks anyway because the meme crowd found a new toy.
That's the disconnect right there. It sums it up perfectly.
But let's connect that Fed cut to the bigger reality. The housing market still feels pretty stuck, right? Kind of frozen.
It does. And there's a lot of skepticism that this Fed cut alone will fix Opendoor's core problem quickly enough. Because, as you know, the Fed cuts the short-term rate.
But mortgage rates follow the 10-year Treasury yield, mostly.
Precisely, and that's critical. Can you maybe elaborate quickly on why that difference matters so much for housing?
Sure. Mortgages are long-term loans, so they track that 10-year yield, which reflects the market's view on things like future inflation, global demand for safe assets like treasuries, and long-term growth prospects. It's not just about what the Fed does meeting to meeting.
Right, and the market's take seems to be that the 10-year yield is still relatively high. High enough that housing affordability hasn't really improved enough
Or at least not quickly enough.
to unfreeze the market and generate the kind of sales volume Opendoor really needs to make its business model work at scale.
So, okay, the Fed might have made Opendoor's own borrowing a bit cheaper, but it hasn't really solved the demand problem yet because houses are still expensive and mortgage rates haven't dropped enough.
Exactly, which forces Opendoor to just try and survive the current situation.
And that leads us straight into the bull case, doesn't it? The whole last man standing idea.
It's probably the strongest argument the bulls have right now. Opendoor is the only major publicly traded iBuyer left. Zillow, Redfin, they both quit the iBuying game.
Zillow famously admitted it was just too volatile, too capital intensive, especially in this rate environment.
Right, so the argument is, if Opendoor managed to survive the absolute worst conditions, that rapid rate spike that just killed inventory turnover, then they're perfectly positioned, like a de facto monopoly, if the market ever does come back strong.
Okay, but I have to push back a little. If the model didn't work for Zillow and Redfin, are we sure Opendoor's issues are fixed just because they outlasted the others? Couldn't it be like being the last man standing in a burning room?
That's a fair question. And that's where the bulls point to the operational improvements they've made. They argue Opendoor isn't just surviving, they're actually adapting. They're proving the model can work, at least on a per-unit basis.
How so? What are the numbers?
Well, overall losses have narrowed quite a bit since the really bad days of 2022. But the really key metric is the unit economics, specifically the contribution margin.
Okay, explain that. What does it show?
It basically measures if they make money on each house they flip after the direct costs of buying, holding, fixing, and selling it. And that number has swung dramatically. It went from negative 3.7% in 2023
So losing money on every transaction.
to positive 4.7% in 2024.
Wow. Okay. That's a big swing. So that 4.7% positive margin is critical. Walk us through why that's so significant.
It's absolutely vital because it suggests the core iBuying activity can be profitable, even with the tough market conditions. Think about it. In 2023, for every $100 in revenue from a home sale, they lost $3.70 after those direct costs. Now they're making $4.70 for every $100.
So the business itself, transaction by transaction, isn't bleeding cash anymore.
Right, which fundamentally changes the equation for long-term survival.
Okay, so that shifts the problem. It's less, can this model ever work? And more, can they get enough volume of those profitable transactions before they run out of money?
Precisely. And you add to that the recent leadership changes. They brought in Kaz Najatian, who was the COO at Shopify, big tech experience there as the new CEO.
And the co-founders came back to the board too, right? Keith Rebois and Eric Wu?
Yep. Seems like a move to inject some new energy, maybe focus on tech and scaling it up. Najatian's already making moves too, expanding their product reach to all 50 states apparently, up from just 50-ish metro markets before.
That's a big expansion.
It is. And they're apparently teasing some exciting new product coming out literally next week, maybe something to make transactions easier or more flexible. So they're trying to position for the long haul, assuming they get there.
Okay, but here's where it gets really tricky. We connect those operational improvements back to the stock price and market cap. Because plenty of analysts, especially value investors, see today's drop not as some temporary blip, but as the market waking up to reality.
The reality of the underlying fundamentals, which that huge rally seemed to completely ignore.
Yeah, let's talk red flags.
Wow.
Unit economics might be better, but the overall business size has shrunk massively, right?
Dramatically. Their trailing revenue now is only about a third of what it was at its peak in 2022, which was a huge $15.6 billion.
15 billion down to maybe 5 or 6 billion now. That's a huge drop.
It is. And even with the narrower losses, every analyst still expects them to be losing money overall, red ink, for the next couple of years at least.
Which leads to this giant valuation disconnect. The analyst consensus might say hold, but that doesn't mean they think it's cheap. Some serious value analyses out there call the stock significantly overvalued.
Yeah, I saw one estimate putting fair value at just $1.14 per share.
$1.14. Compare that to today's price, even after the drop. It's still around $7.40 something.
That implies what, something like a 633% overvaluation compared to that specific fair value estimate? It's a massive gap.
Which brings us to a really critical risk for anyone buying in now: dilution. What is management likely doing while the stock price is or was so inflated?
Well, this kind of rally, even if it's based on hype, presents a golden opportunity for management. They almost certainly have an at-the-market offering facility and ATM ready to go.
Explain the ATM quickly. How does that work?
Sure. It's not like a big one-time stock offering. An ATM lets the company sort of quietly, continuously sell new shares directly into the market. Basically, whenever the price is high, they can just drip them out.
So they take advantage of those moments of like peak retail buying frenzy when the stock was near $10.
Exactly. They can sell shares at those inflated prices to raise potentially hundreds of millions in cash, which, frankly, they desperately need.
So management is basically using the meme stock rally itself to fund the company's survival. It's the bridge they need to hopefully reach profitability someday, but who foots the bill?
It's the people buying the shares at these high prices. The retail investors hoping for that next big jump. They're the ones who get diluted.
How does the dilution work?
Simple math. If the company raises, say, $500 million by selling 100 million new shares into the market, then the ownership stake of everyone who held shares before and everyone buying now instantly shrinks. There are more slices of the same pie.
It's a totally rational move for the company to survive.
Absolutely necessary, even.
But it directly penalizes the very investors whose enthusiasm created the high price in the first place.
It's a wild market paradox, isn't it? The irrational hype fuels the rational need for capital, but it means the buyers face this tough situation. If Opendoor does survive long-term, partly because of this cash raise, their shares will be worth less because of the dilution.
And if Opendoor doesn't survive, well, the shares could go towards zero anyway.
Yeah, it's a tough spot for recent buyers. The real winners might be the very early investors or management successfully using this moment to strengthen the balance sheet. That gives them more time, more runway to wait for that housing market recovery.
Okay, let's try and synthesize this. For you listening, trying to decide what to do with Open after today's drop, what's the bottom line?
Well, today's slide seems clearly driven by that speculative money moving on, which just highlights how little fundamental support there was for that massive rally.
So the decision to buy now really comes down to your belief about the long game.
Exactly. Do you believe Opendoor can actually tough it out through this frozen housing market for long enough? Long enough for those operational gains, like that positive contribution margin, to really matter when rates eventually normalize and sales volume picks up again?
That's one side. The other side is, do you think the risk of more dilution is just too high? And is that $1.14 fair value estimate or something like it, closer to the real underlying worth?
It really is a classic, high-risk, potentially high-reward bet. And it all hinges on the timing of a housing market turnaround versus the company's cash burn and dilution.
Which brings us to our final thought for you to chew on today. This whole situation with Opendoor getting a potential lifeline from meme stock enthusiasm, it raises a bigger question.
Yeah, think about it. The rally gave them access to cheap capital, inflating the stock price way above fundamentals. If market euphoria can be leveraged like that to get real cash and survive a downturn.
Does long-term success for some companies now depend less on their immediate business performance and maybe more on their ability to successfully tap into that investor excitement when it happens, using hype itself as a bridge to eventual profitability?
It's definitely something to consider in this new era of market dynamics. A lot to think about there.
Absolutely. Thanks for diving deep with us again today. We'll catch you on the next one.